They create the, I just had it, the BTFP, Bank Term Funding Program, which basically says, hey, everybody, don't worry, your deposits are safe. But the problem is that puts them on the hook for up to $4.4 trillion that they would have to print their way out of. So do we still have a banking crisis, or do we only have a looming potential inflation crisis?
There is a political choice. Either, as people say, again, I haven't looked at the deposit rates yet, but if you are a non too big to fail bank, there's 8 of them. It's very hard to attract deposits, and it's very hard for you to raise your deposit rate because, again, you have this portfolio of stuff, and your deposits are not guaranteed. So if I'm a JP Morgan, a Citibank, a Wells Fargo, I forgot the other ones, the big banks, they have an unlimited deposit guarantee. Now they have to pay a bunch of other charges for that. But if I'm a depositor in those banks, I know there is no question. The politicians have told me I will get 100% of my money back, no limit. If I'm not in one of those banks, I have to think to myself, okay, is this bank going to get saved? Is this going to be the Lehman Brothers, or is this going to be the Goldman Sachs? Which one is going to be, right? They let Lehman fail. They didn't let Goldman fail, right? And so it's the thought. And so you're like, well, why even take the risk? Get me the fuck out of here. I'm giving my money to Jamie Dimon, right? And so that's the issue. People are fleeing because, number one, the political choice has been, we are not going to extend a blanket guarantee to all these other smaller banks because of moral hazard and all these different things. We're only going to give it to these banks over here. So then the rational response of the public is, well, I don't want to be in that bank. I don't want to have to take the risk that they decide that this is the bank they're going to believe in capitalism on. I'm going to go on over here. Let me go to socialism. I get my money back. And so I think that's driving part of it. And then the other thing is the rates are still going up, right? 5.5%, maybe the Fed raises a couple more times, maybe it'll be 6%. I can literally 2 clicks, go online, go to my money market account, deposit money with the government essentially, and get more money than my bank can mathematically pay me. So yes, there's a banking crisis. It was smoothed out a bit with the bank term funding program, but it's not as if people have stopped noticing that in less than 5 minutes, they can, go from 0% to 6% interest income. That didn't stop. So the banking crisis is still there. The acute political choice that the regulators and the government is going to have to make is still there. It's still looming. Who is going to pay for these losses on the bond portfolios of all these banks? I don't know what they're going to decide, but I think they're going to decide to print the money and make sure that the electorate gets their deposit back in nominal dollar terms. So that's just my opinion.
So the bank term funding program does not cover regional banks? I thought it did.
No, it covers banks that have eligible securities. So that essentially means U.S. Treasury bonds and mortgage-backed securities. Now, the big thing that a lot of people are now focusing on is the commercial real estate, right? That's not included. So it's not as if I lent money to some real estate developer in some market who's going to build office buildings. I can't take that loan right now and give it to the Fed and get back 100% of my money back in dollars, right? I can take a treasury, I can take a mortgage-backed security, I can swap that for dollars. I can't swap commercial real estate, which is a problem because small regional banks were the engine of commercial real estate lending boom over the last, decades, whatever you want to call it. So now as we're changing the way we work and, 2 to 3 days work from home for a lot of folks, these office buildings are becoming kind of irrelevant and the market has frozen. So now it's a question of, okay, when deals get done, how big is the price decline going to be? And then are banks going to have to write down this section of their balance sheet and, oh shit, they're insolvent again. Or at least we know they're insolvent again. Or what's the Fed going to do? Are they going to expand the BTFP to include commercial real estate loans? Because this is the thing that's going down in price. Or are they going to expand it to auto loans? Or are they going to expand it to, personal loans? Like all these things that the banks have been lending out where the ability to pay or the asset value is declining that aren't U.S. Treasury bonds and mortgage-backed securities. Is the BTFP going to be expanded to cover those? Because if those go down in price, the banking system's still insolvent, right? And so, yes, they've solved one portion of the market, the one they really, really care about, which is mortgage-backed securities. They want Americans to own a house and U.S. Treasuries. They want Americans to invest in the government. Now, there's all this other stuff. They would rather not have to bail it out. But again, the banking system is choking on all this stuff. And they're going to have to make the political choice at some point. Either they're going to let the non-too big to fail banks actually fail, and a lot of Americans with small deposits not get their money back, or they're going to come in and save the day and bail everybody out and print more dollars.
Okay, I think this is the part in our program where we point out exactly what inflation is. When it was first described to me as an invisible tax, I was like, it didn't make sense to me. And now, understanding it better, I realized that what you're doing is you're saying, okay, we're going to make everybody's money worth a little bit less. So by making more of it, then the value of any $1 just reduces a little bit. And so it becomes a way to spread the taxation across everybody. So the real question the government is asking is, okay, this bank, whatever, they did something that isn't, so we already know that mortgage-backed securities and treasuries, those are going to be one for one. But if they have something other than that, they're asking the question, do we want everybody to have to cover this thing that didn't end up working out, this investment that didn't work out, or are we just going to let them roll over and die? As you look at that, and when you think about this 3 to 6 month big disturbance, is that the thing that you think happens, that we get something triggers a run on these small banks? Could be commercial real estate starts, something kicks off and it starts going down, or are there other things on your bingo card other than the regional bank failures?
I mean, usually it's the problems are known. It's a question of whether or not we're focusing on, and we being the market, right? So the market knows the commercial real estate's a problem, but we haven't really seen a big price markdown because no one wants to trade. The sellers don't want to realize a loss and then have to mark the rest of their portfolio down and thus be insolvent. And the buyers don't want to buy at this price because they know it's too high. So nobody's trading, right? So it's that calm situation where, okay, well, the price is still where it was 12 months ago, but there's no transactions, right? So once there's a few transactions, when people have to sell for whatever reason, we don't know what that it's going to be, then we're going to go, then it's the fiduciary responsibility is, okay, well, there are these transactions in the market, and I now need to mark down my portfolio, report to my regulators, oh shit, my capital buffer is declined, therefore I'm insolvent. And what usually happens is, because of the politics, they'll let somebody fail. There's gonna be at least one failure. And then the market's gonna fucking throw a fit. Shit's gonna be trading all sorts of fucked up ways. And then, on one weekend, they're like, okay, we can't let the next one fail, right? They let Silvergate fail in March of this year, but they didn't let SVB, and by fail, I mean Silvergate went bankrupt and the depositors are not guaranteed to get their money back by the Federal Deposit Insurance Company, the FDIC. Whereas with SCB and Signature and First Republic, they were bailed out. They being the depositors were bailed out. Now, obviously, the bank management was replaced and equity holders lost money, but the depositors were bailed out. So usually one person fails. There was a Lehman, there was a Bear before there was Goldman, Morgan Stanley, everybody else, Citigroup. So they'll probably let somebody fail first because the politics demand it. Once the fear of looming collapse is instilled in the regulators, they're then going to say, we have to print the money because the system is going to fail. What that's going to be, I don't know. I just see that for whatever reason, financial crises happen in the fall and in the winter in the northern hemispheric perspective. And so we haven't solved any of these problems. They're only getting worse. They're getting exponentially worse. And the countries that would usually bail out the American financial system by buying assets for their own reasons can't do so. And so as we progress further into this season where traditionally crisis happens, there's going to be something. I don't know what it's going to be. That's just my base case. And I want to prepare myself and make sure that I'm able to make money in a situation where shit gets all fucked up.
Yeah. Okay. I didn't know that there's a preponderance of problems in the fall and winter. Is that the obvious guess for somebody that's never heard that before would be it has something to do with energy prices as people have to crank up their
usually. So in the past, it was agricultural issues, right? So the farmers, the credit tightens in certain parts of the year, depending on when the farmers need credit to, buy more equipment to do the winter planting, right? They receive a bunch of money. Now they need to draw down on credit. And so that's why you get the spikes in credit as we move through the agricultural cycle. And that's part of the reason why you have different Federal Reserve banks in different districts, is to try to smooth out that the demand and supply of credit between the banks in the east and the agricultural regions in sort of the center of the country. And every other country is kind of the same, right? Farmers are always in debt, and they're always borrowing money and then receiving lots of money depending on how the harvest goes. And I think that's part of the reason why we usually experience crises in harvest season and then winter planting.
Now, you said the problem is usually known, but it's a question of whether the market's paying attention to it or not. What are some of the problems that you're already aware of, whether the market's focused on them or not, that could be those early dominoes that fall?
So we already know that the U.S. banking system is insolvent from a U.S. perspective. We already know that the major buyers of U.S. Treasury debt are not buying, and the Treasury needs to issue a lot of it. That's known. We already know that commercial real estate in the U.S. is a problem. It's just that nobody's trading right now because of what I just described. Globally, we already know that China has this massive real estate issue and is deleveraging, which means that China cannot contribute to global growth in the ways that it used to, meaning doing massive government stimulus and essentially buying stuff from the rest of the world to build up their country, right? China's been the economic powerhouse of global growth, which leads into the US and European economies, since the early 90s. They have lost their capacity to stimulate in the ways that they're used to. Japan has a problem. Either they're going to save their government bond market or they're going to save their currency. Japan is one of the richest countries from an asset perspective on their balance sheet. Are they going to sell down their treasuries, their fancy U.S. real estate, their equity positions to essentially help fund the ability for their central bank to manage the depreciation of their currency? So these are all known things. There's nothing hiding. Which one is the one that causes the spark for everyone to start focusing on and freaking out? I don't know.
If you like that clip, check out another powerful clip right here, and I'll see you there.